Today, results out from the company that makes up about a fifth of the JSE. Naspers, considered the largest share on the JSE right now, often taking the local bourse in and out of positive territory depending on its performance. Well, it's reported a 22% increase in group trading profit. Its e-commerce business posting a strong performance and reduced trading losses by a meaningful 14%. Core headline earnings from continuing operations up 26%. Naspers also announcing its intention to list its international internet assets on Euronext Amsterdam. Well, ENCA's business producer, Rafael Madzena, joins us now in the studio to talk about this. Well, Rafael, good day. You would be happy if you're holding a Naspers share, and it looks like the transitional years have been good.
Yeah, Devon. So they did announce last year that they were going through a transformational phase, really trying to become an e-commerce giant globally. Yep. So now they're operating in over 50 countries in the world. And really part of that transformation of theirs was to get rid of their business MultiChoice. So solely focusing on online businesses, which include food delivery, fintech, and the like. So we saw an increase of 29% in their earnings there, as you've just mentioned, and really just less in terms of losses that these e-commerce businesses were bringing in the previous period. So the interesting thing about these e-commerce businesses is that Naspers hasn't gone the route of other companies globally that are trying to grow. They've been investing in startups. So those losses that we would have seen in the previous period would have been understandable, given that these are startups that the company is investing in. And its latest investment, which is really exciting for the South African market in particular, is one called Sweep South, where it's a cleaning company, an Uber for cleaning services. Yep. 30 million rand into that company. And really, they have indicated in their results that their spending spree is not over. They are on an acquisition path and really looking for pockets of opportunity globally. They look mostly in Asia as well as South America. We've seen revenues stronger there.
And they can be convincing, because we'll just pop up the performance over the past few years, and it does show us that, look, a convincing case coming from them.
Absolutely a convincing case. I mean, their company has grown 72-fold in the last few years. And you've seen, as you've mentioned earlier, if you are a holder of Naspers shares, you're a very happy investor, because the yields you are bringing in from this company are very good. So we're going to be seeing that their listing on Euronext in Amsterdam is going to contribute to the growth of the company. But there are debates around whether or not the company has now become too big for the JSE. Are investors getting true value from the company, given the weight that it holds on the JSE? And Tencent as well, which has brought in quite significant investments for them.
I want to bring that Tencent component in here, because it's not all smooth sailing back home here. They are butting heads with the PIC over Tencent. They own a third of Tencent, Asian company in China.
That's right, Devon. So a couple of days ago, an interesting story was published about the fact that the PIC is looking to perhaps sell 240 billion rand of its stake in Naspers. It owns that's about 16%, and it's really worried about the exposure that Naspers has to Tencent. And the biggest reason that they've cited here is that even though Naspers has a third of this company, which is the world's biggest gaming company now, by the way, they don't have control over the decisions that Tencent make in terms of investments and the like. So should the share price crash, you would see a significant hole in the earnings in Naspers, as well as the investors. I mean, we know that government pensions are really the investors in that 16% that we're seeing in there. So the PIC indicating that it's really not a safe bet to have such a heavy buy-in in one company where there's really no say or any kind of control in China, Devon. So I think those conversations are ongoing in terms of how much of that stake it will sell and really where it will be looking to further invest.
And before I let you go, the company that they spun off earlier this year, MultiChoice, under that you have DStv, letting go about 2,000 jobs for the same reasons that Standard Bank says it's letting go of people. Tell us about that.
Yeah, so I mean, you would have been, if you weren't a market participant, you would have been a little bit surprised, given that earlier this week, MultiChoice released their results, and they were very solid, and solid growth in the African continent as well. But they have indicated in the statement released today that they're just not getting in, people calling into their call centers or walk-in centers anymore. They've seen a decline over the past 3 years. In fact, what they have seen is about a 70% growth in people going online to get services services from DSTV or MultiChoice as a whole. And what the company's strategy is now, because of increased competition in an unregulated OTT platform, they are going to have to put a lot of investment into those platforms and really provide the services that are going to be competing with the likes of Netflix. So we're seeing one way in which they did that was introducing SuperSport live matches, cricket, rugby, and the like, onto their platform Showmax as a way to compete with the likes of Netflix. So they're going to be putting a lot of investment into their digital platform, whether it's to offer streaming services, video on demand, or whether it's to offer customer service on the pay TV channel or channels rather, or the likes of Showmax.
No, interesting indeed. Rofiwa, thanks very much indeed for coming in. Rofiwa Madzena there from ENCA's Business Desk.